It's trading in the green after reporting a good set of Q4 numbers. The revenues jumped almost 60% year-on-year, and Q4 margins came in at a multi-quarter high. We have Arun Kumar, who's the Group CEO and Managing Director at Strides Pharma Science, who joins us now. Mr. Kumar, thanks a lot for joining us. A pleasure having you here on CNBC-TV18, especially at a time when the numbers are looking quite good. If you talk purely about the US sales, they've been above $60 million for 3 consecutive quarters. Of course, this time it was flattish on a quarter-on-quarter basis. But tell us, has the pricing pressure subsided? Has US picked up compared to what we've seen, say, about 5-6 quarters ago? And what will the run rate look like in terms of sales over the next few quarters?
Thanks, Sonia. So firstly, Strides does have a very differentiated portfolio for the US. We've actually reset the company's US strategy to go back to our niche products. What is important to note is that almost 80% of our sales in the US comes from products where we are number one in terms of market share. So 19 products, as per IMS data, we are the number one in terms of both value and volume. This additionally supported by over 200 odd products that we have approved but not launched, allows us the flexibility to accept a challenge on price and let go of product when it's not required. So we are under no urgency to grow our business rapidly. So I'm not suggesting that there is no price challenges, but in our portfolio, because of the luxury of a large bank of products that we have still not launched, we are able to keep our margins high. So we've gone back to our historical margins consequently. And if the sequential growth is not excessive compared to the previous quarter, but significant to the year, it is because we follow the strategy. So sometimes we do get challenges and we are happy to let go of a product because we don't want to be in a position, as you're all aware, that the regulatory oversight cost for the industry has gone up quite significantly. And the pricing has to, effectively mirror the increased cost of compliance. So we are very focused on that approach.
Okay. All right. Mr. Kumar, hi, this is Ekta and welcome to the show and congratulations on what has been a great quarter for you all. $232 million in terms of US sales in FY23. That's in the middle of that $220 to $240 million guidance you had provided. What is your guidance for FY24 when it comes to the US business?
So, Ekta, I came back from a good life in retirement to run Strides, as you're probably aware. So we had never lost money in any financial years except in FY21. We actually gave a guidance because we wanted to do that. Typically, we don't guide. As you know, we are very miserly with our guidance. But again, we have given a kind of a guardrail guidance of around 15 to 20% growth, but more of the growth is now coming from our emerging market strategies. We've just about completely integrated the Endo acquisition and the portfolio and the manufacturing site, not the company rather. And we think that there's a lot more to play out in terms of market share. So the next year will also, you will see a 15-20% growth, which will be great, but not like the 58%, considering that we had a massive drop due COVID, because as you probably are aware that we normally operate only in the acute therapies, which means during the COVID time that took a big hit for the whole global industry. So that would be a good kind of a guardrail guidance in terms of growth overall, with US continuing to be an important part of that strategy.
All right. So overall, 15 to 20% growth is what you're looking at. I wanted to get more granular details with regards to Stelis, because that made an FY23 loss of around 799 crores. Yes, there was a write-off on account of COVID-19, I would understand. You have reduced debt there. You are anticipating a positive EBITDA in FY24. But what is the larger plan for Stelis? There is some amount of restructuring which is also being considered. Tell us what we can expect for Stelis, say, by the end of July to August.
Right. No, you're right. So, we have had a very significant challenge with Sputnik and the write-offs related to that. That's behind us. We invested a little over 1,000 crores on the vaccine opportunity. But luckily for us, we built that plant as a multi-purpose biopharmaceuticals facility, considering the major flagship plant in Bangalore now has received US FDA approval. We believe that by far we are the most focused and dedicated biologics CDMO. Since our FDA approval of the site, in fact, we had 2 inspections and 3 approvals, including a virtual. Customer approvals have now commenced, and commercial sales will start from H2, which is very big for us because the whole incubation time of onboarding a customer in the CDMO space is high. And our OPEX leverage is currently, the occupancy is very, very low. So as we start increasing our occupancy, you will see the OPEX leverage and the margin flow through to be high. That gives us the confidence to guide that we will be EBITDA positive. In terms of what we also mentioned in our earnings call is that, I've come now full time to run the company, and I'm going to stay invested in Strides and these opportunities that we still have. But I agree with you, to build the biologics business into a niche CDMO is my highest priority. So we are making actions. I mean, there's a strategic review, and international banker has been appointed. It's not about exiting the business at all. We've invested a lot of capital, but considering the setbacks that we've had with the vaccine situation, we are kind of resetting that business, and we should be in a strong position to announce those actions with our Q1 results.
Okay, I guess it's the need of the hour, right? You need to cut your losses at some point, and it is a steep loss, almost 800 crores in the year gone by. Got that. We'll, of course, await more details on what you plan to do with Stelis. But I also want to understand more about the deleveraging, because the group has repaid about 700 crores of debt in the year gone by in FY23. What is the plan for FY24? Any more debt reduction? And what are you comfortable with in terms of debt equity ratio?
Yeah, so we've committed. If you look at our outlook for FY24 Strides, we target to be under 3. We started FY23 with an 8-time leverage, which has now come down to 3.4. And our focus has been cost rationalization, network optimization, and improved gross margins. We have added 900 basis points in terms of our gross margins. All of this has helped us to solve for a lot of things, but I think another one solid year of performance will ensure that we can continue the deleveraging. So we have actually guided a 500 crore minimum debt reduction in this financial year between the two, Stelis and Strides, and then that hopefully should get us below 3, which is our comfort zone for FY24. And historically, we would be always under 2. That is something we hope to achieve by FY25 of 26.
Okay,
and that,
well,
when I talk about consolidation, obviously, I am also adding the debt related to Stelis.
Sure, got that. Always great speaking with you and understanding more about the industry and the business. Appreciate your time here on CNBC-TV18. Thanks a lot for stopping by. That's a rare interview.
Bye-bye.
Thank you for joining us. Okay, that's a